when the budget was going to be announced. Of course, you went through a couple of other important events like the quarterly results, which you very well highlighted in the calendar. But did running up to the budget lead any change or any change of thoughts in terms of your approach towards your portfolio on an overall basis? And did you do any action in the portfolio for that?
Yes, sir. In this case, what we'll say is that initially, we didn't invest into companies like VATech, Webback. So for this was completely like we got that into in our 10 stocks which is shortlisted. But then we were waiting for this so that because we knew that this would be a stock which would be sensitive to the budget, because going forward there is the Swachh Bharat Abhiyan. So we targeted this company towards that budget. So and we got a good enough profit on this on this stock as well. So we look to continuously rebalance our portfolio as well as exit a few stocks based on the budget.
So you did some portfolio rebalancing, but you retained 90% invested into equity stocks even through the budget till the last date when you sold that, right? That's what.
I would suggest that, while the criteria has not thrown any financial services, try to apply it in such a manner, tweak the model to see if financial services could have been put in, because finally that's the barometer of Indian economy.
Just to add to what sir is saying, debt is a raw material for the financial service industry, kind of 1:9, 1:10. So therefore applying 1:1 ratio to the financial services, you are not justifying. So therefore, while you select a financial criteria, but you have to apply it to different industry in a different manner. Kind of invariably it's 1:9, 1:10, 1:11, it should be in that range. So be mindful of that. That's the only thing.
Thank you, sir.
I'll now be requesting the other team, Team Silent Wolves. The fund manager for the team and also the presenter for today is Mr. Kadiresan. All the best. One thing, please strictly abide by the time. It's 20 minutes for the presentation and 10 minutes for the question answer. After 18 minutes, we'll give you a warning as to only 2 minutes are left. And post which 10 minutes for the question answer. Also at the end of 10 minutes, we'll give you a signal that the time is over. Good luck, guys.
Stock market is an ocean. Many people have successfully sailed in it, and many have drowned too. Good morning, everyone. We, the Silent Wolves, are here today to present to you how we managed to cruise through these market waves in these 42 days. I'm Kadiresan, and I'll be taking you through the presentation today. Presenting the highlights of our journey, that is the snapshot or the dashboard of our portfolio. Our investment style was quant-based, and the investment period spanned from 3rd January 2015 to 3rd March 2015. The portfolio gave us gross profits of 5,660 Indian rupees, and we also incurred transaction charges and taxes of nearly 1,527 rupees, which resulted in a net profit of 4,133 Indian rupees, which is 3.3% of the investment amount of 1,25,000. The stock that gave us maximum returns was Britannia, around 4,000 rupees, and the stock which gave us maximum losses was Bombay Burma Trading Company, around 400 rupees. A linear extrapolation of the portfolio performance for the rest of the year will indicate an annualized return of 21.3%. These are the major stocks that are indicated which we had in our portfolio, and I'll be taking you through the portfolio performance at a later point of the presentation. Moving on to the risk profile of the team. All the team members took 2 tests. The first being the test taken by Zhang self-rating tool to measure the anxiety score of the individual. And the second test was taken using a tool called the ICICI risk profiling tool to measure the investing risk. But why 2 tools and why 2 tests? The first one, the anxiety score, indicated the amount of risk and the amount of stress that a person can handle. Whereas the second one took care of the financial investment risk that the person can take. So on an aggregate based on all these scores, we arrived at our team's risk-taking profile as aggressive, moderate to aggressive. Moving on to our strategic plan. We started by selecting a universe of 10 sectors. And also we used the past 1 year's return of all these 10 sectors to analyze them. How did we select sectors from those global 10 sectors? We had a customized scorecard to pick the top sectors from that available 10 sectors. I'll be taking you through the scorecard in a minute. After selecting the top 4 or 5 sectors in the second step, the next step that we had was fundamental filtering. Actually, this was a requirement according to the SMIC courses guideline that we have to follow these fundamental filters. So all the stocks which were a part of those 5 sectors were passed through these fundamental filters, and all the stocks which passed these fundamental filters were taken to the next step. The next step is the stock selection, and here we again had a customized scorecard for picking the best stocks amongst all the stocks which crossed those fundamental filters. And finally, after selecting the 5 stocks which came according to the scorecard, we allocated weights to those stocks based on maximizing Sharpe ratio model. So this is the stock sector selection scorecard which I was talking about. We considered 3 factors over here: average return, standard deviation of the sector, and the Sharpe ratio. We actually took the sectorial indices of the corresponding 10 sectors as listed over here, and we measured the average return, standard deviation, and Sharpe ratio, and gave weightages of 0.25, 0.25, and 0.5 respectively to these three factors. And then we arrived at percentile ratings for all the 10 sectors, and then the weighted average of these percentile ratings along with the weights for the factors gave us the final score for that particular sector. So based on this, these 5 sectors were selected as the top performing sectors amongst these 10 sectors: automobile, banking, media, finance, and FMCG. So once we selected the sector firsthand, then we selected all the stocks which are a part of these 5 sectors, and all those stocks were put into these fundamental filters. They have to be listed, they have to be a part of BSE 500 or NSE 500. They have to have at least 300 crore as market cap, and then the sector filter. Sector filter is nothing but only those 5 sectors stocks can be taken forward. And we also had filters such as net income and free cash flow should be positive, and also the return on capital employed should be at least 10% to ensure that we invest in stocks that are fundamentally strong. I would like to take a break from the flow and say that we try to plot where our portfolio lies in this grid. And then we realized that it lies over there. We ended up in large row just because of one of the fundamental filter that it has to be at least 300 crores of market cap. That's the reason we ended up in the large row. And then why did we end up in the growth column, sorry. As it is indicated here, our portfolio's price to book ratio, price to cash flow ratio, and price to equity ratio are much more higher than the benchmark's value. This basically indicates that the stocks that we have chosen basically belong to the growth category, and that's the reason we have ended up in large and growth combination. So resuming back to the flow, now we have selected the sectors, and then we have shortlisted the stocks which pass through these fundamental filters. The next step will be the stock scorecard that will be used to select the top 5 stocks alone. This is the stock scorecard that I was talking about. Say for example, 100 stocks come out of the fundamental filters. We rate each of these 100 stocks based on these 3 parameters, namely average returns, Sharpe ratio, and trainer ratio, with a weightage of 0.4, 0.3, and 0.3. Similarly, we have a percentile rating, and we take the weighted average of that to arrive at the final score for every stock. And we arrange the stock in descending order, and we select the top 5 stocks. The top 5 stocks selected in this slide accordingly are Aker Motors, CAR Ratings, TVS Motors, CCL Products, and Britannia. So once we arrive at these 5 stocks, that these are the 5 stocks which we are going to purchase, the next step will be how much do I put into each of these stocks? How much money do I put into each of these stocks? So that will be determined based on this weight allocation model. The first row which you see over here, the weightage, the 0.15 and 0.24 have been obtained through the maximizing Sharpe ratio weight allocation model. So once we arrive at those numbers in the first row, we multiply it with the corpus amount of 1,25,000 and we come to know how much should be invested in each and every stock. Then we divide it by the actual share price of that stock to arrive at the number of stocks to be bought. And then as it won't be a decimal number, we round it off to the nearest integer where we do that. And the adjusted number of stocks, that row indicates how many number of stocks we buy in the respective stocks. So how did we arrive at the stop loss and profit booking levels? That is explained in this table. We took 0.5 standard deviation, 0.5 times the weekly standard deviation of the share prices of each and every stock, and 0.5 standard deviation above the buying price became the profit booking level, and 0.5 times the weekly standard deviation of the stock below the buying price of the share became the stop loss levels. And that's how we arrived at the stop loss and profit booking levels of all the stocks, and that has been mentioned in this table as well. So this pie chart indicates the portfolio composition according to whatever stocks we have chosen and whatever weights we have allocated. Aker Motors, CAR, Britannia, CCL Products, TVS Motors, Infosys. So after allocating, this process has been done on every Friday evening after the markets are closed. And this model will tell us which are the stocks to be bought and in what quantity. So that will be executed once the market opens on Monday morning. So this rebalancing happens every Friday night and we make the transactions on Monday morning. So that's how we weekly rebalanced our portfolio. I'll take you quickly through some of the weeks, important weeks and happenings in few of the important weeks, how we crossed through. Say for example in week 2, when we ran the framework on week 1's Friday evening, it suggested that Kaveri Seeds and Maruti Suzuki should be sold out and CCL Products and TVS Motors should be brought into the portfolio according to the scorecard with the respective weightages. So we did that. And one more important learning in week 2 I'd like to highlight, the emergency selling. What happened during execution of transaction week 2 was, we actually exceeded the amount of 1,25,000. And the broker very convincingly convinced us that we can trade up to 4 times the investment value of 1,25,000. He was very convincing. He said that we can trade up to 1,25,000 into 4, which comes around 5 lakhs. You can trade till that is what he said. It was very convincing. We presented it to our professors and everything was fine. 2 days later, exactly 2 days later, I get a message on my mobile saying that you have exceeded your investment limit. You either better deposit extra amount or we are going to charge you a bomb of interest rate at 18%. That's when we entered emergency selling and we sold few stocks and brought our portfolio value below 1,25,000. As our professor always says, there is no free lunch in finance. Moving on to week 3. Week 3, we updated our strategy. Just a second, sorry. We wanted to focus more on the momentum stocks as per our strategy, and we introduced 3 new ratios to assist us in this process. We introduced 3 new ratios called the peak ratio, which is the current stock price divided by 52 weeks high. Ideally, this peak ratio should be less because the current stock price, if it's very near to the 52 weeks high, it indicates that the share price is near its all-time high. We didn't want such stocks, so ideally the peak ratio should be low, whereas the monthly shoot and weekly shoot should be high because those two indicate the momentum at which the stock is progressing. So based on these ratios were incorporated into the scorecard which I explained to you in the previous slide. And after that, the scorecard consisting of 6 parameters now suggested that Bombay Burma Trading Company should be included into the portfolio. And we sold off Infosys as it reached its profit booking levels. So these were the highlights of week 3. Similarly for week 4 as well, at the end of week 3, that is Friday evening, we ran the scorecard again and we balanced the portfolio on week 4's Monday morning. This is my most favorite slide in the entire presentation. On week 4 Friday evening, we ran the scorecard. The scorecard asked us to make drastic changes to the portfolio. You know what it said? It said sell off your Aker Motors which you have in your portfolio, sell off CAR Ratings which you have in your portfolio. So 2 stocks are completely out of your portfolio and bring in 1 new stock completely into your portfolio, that is Nerolac Paints. There was a half-an-hour debate in our team Two people suggested that we are quant-based fund, we need to stick to the framework, just do what the framework says. Two other argued that it doesn't make sense at all to completely remove two stocks from the portfolio on a whole and include a new stock. This is going to charge us a bomb of transaction charges. Thankfully, week 5 was only a 4-day week because one day was off because of a government holiday. So what we decided finally was, we'll call week 5 as the trial week. We decided that we'll stick to the same stocks as we had in week 4. So week 5 will have the same stocks as of week 4. And we measured the performance of the portfolio in those 4 days at the end of the week 5. So that you can see in the orange line indicated over there. And what did we do different? We simulated a pseudo portfolio. If at all we rebalanced according to what Scorecard suggested us to do, what would have been the portfolio and what would have been the performance of that portfolio. That also we monitored and we plotted the performance of that portfolio, which you can see in the blue line. The interesting point is that both these portfolio performance have moved in sync. That is, the first 3 days they were in upward trend and the last day it actually fell. But what is the differentiating factor between these two portfolios is the point from which they started from, the first day of the week. That huge gap can be very much attributed towards the transaction charges. Had we rebalanced our portfolio performance would have been the blue line. But just because we chose not to rebalance the portfolio, we avoided that gap of transaction charges and we had that orange line as our performance for week 5. So the major learning from the course itself, I'll say, don't trade, do invest. That was the learning that we derived from week 5. Moving on to week 6. Actually, the initial strategy which we proposed was at the end of month 1, which concluded in week 5, at the beginning of month 2, which is week 6, we'll actually rerun the sector selection process. Because for every month we thought of selecting new sectors. But then the learning of week 5 said, don't trade, do invest. We should not be frequently changing our stocks in our portfolio. So we decided to stick to the same sectors as we had in month 1. So it says no sector selection for month 2. And also the scorecard suggested, so with the same sectors also, the scorecard suggested us to replace Britannia with Nerolac Paints. But the change in ranking was just one. From 5th ranking, Britannia went to 6th ranking. And Nerolac Paints overtook Britannia from 5th ranking and Nerolac Paints became 5th ranking. Basically to say, there was only just change of only one rank in the scorecard. So the team again decided that just because there is only one change in ranking, let's not rebalance it, and we stuck to the same portfolio. In week 7, we came to know that there were only 3 weeks prior that we have to liquidate our portfolio. So we initiated the exit strategy when we decided that we are not going to rebalance our portfolio anymore from week 7 onwards, and we are going to focus only on profit booking, and if at all any stock reaches the stop loss levels, we'll do that. If at all any stock reaches the profit booking levels, we'll do that, but no more rebalancing is to be done. That was decided in week 7. So in week 8, one of the stocks again reached the profit booking levels, Britannia, and as per the strategy of the team, we sold 50% of Britannia because our strategy was whenever a stock reaches its profit booking level of 0.5 weekly standard deviation, we will sell off half of that stock that we have in our portfolio. And for the remaining half of the stock, which is still in our portfolio, the current selling price becomes a stop loss. So based on that, we sold Britannia and booked profits. And week 9, the final week, we had the exit strategy because the budget was on cards. We had the exit strategy as if the market rallies, we'll be liquidating 10% every day on a daily basis until budget. And if the market keeps dropping, we'll hold on till the budget and then liquidate later. So this is the portfolio performance that I would like to show. So the red one indicates our portfolio and the orange one indicates our benchmark. We chose our benchmark as Reliance Quant Plus Fund. There are few reasons why we chose this as our benchmark, because they were also quant-based funds and the sectors which they invested in were more or less similar to our sectors, and they also did weekly rebalancing, and they also had a combination of they were not purely quant-based. They had quant-based plus analyst discretion was also there, which was the case in our portfolio as well. That's the reason we chose this. We calculated Jensen's alpha according to the Pharma French 4-factor model, and we calculated the respective betas. The betas speak for themselves. Small minus big, it is very less. It is obvious because we have invested in stocks which are market cap of at least 300 crores. And the beta HML, high book to market minus low book to market, that is again because of fundamentals. The one important point to be noted is beta WML, winners minus losers. We can see that beta is extremely high of 0.9. That is in very much synchronous with our strategy of investing in momentum stocks. And the beta with respect to the market, that is indicated in the 5th row, is 0.563. So moving on to the learning slide, as I already said, the trial week number 5 indicated don't trade, do invest. And the second important learning which we derived was stringent rules don't work always. One of the main reasons why we weren't able to beat the benchmark was because of the stringent rules that we had with respect to the profit booking levels. We had the profit booking level as 0.5 standard deviation, and if the stock price was even just 1 or 2 rupees below the profit booking level, we decided not to sell it. We strictly stuck to the rules, and that's the reason we lost on many profit booking potentials. So strict rules don't work always, and especially that too in a 2 months investing period, strict rules don't work. And the third learning, the obvious one, when you get to work in a team like this, it's not I, it's we. Be it the celebrating times when we booked profits, or be it the nail-biting times when other teams overtook us in terms of returns, the silent wolves always played it together. Thank you.
Can you tell us the stock-wise performance? Cumulative since how much you made?
Okay, that information we don't have it in the PPT, sir. Like every stock.
So, okay, what is the highest return of the portfolio is Britannia, right? You said
Highest
20.
return was in Britannia.
How much was that?
4,000.
No, percentage terms, because you have totally performance is some 3% or something.
Yes, sir. Yes, sir.
So what is the performance of that single stock? Single stock is how much?
So 6%. For Britannia.
So what is the highest performing stock return?
So Britannia was the highest performing
Which is at
stock,
6%.
Which is 6%.
And lowest performing stock?
So BBTC incurred losses.
How much is it?
400 rupees in total. Percentage wise, not sure. So
Is BBTC part of the same Britannia group?
No.
You sure? It's not part.
it's Bombay Burma.
It's a Bombay Dyeing Group, no?
So Bombay Burma Trading Company. It's not
It's a
Bombay.
Bombay Dyeing Group, no? Bombay Dyeing Group. Which is the same group, no?
Yes, sir.
So perhaps you should keep track of the fact that you have such a small money and you're giving to
But
the same group.
selection was more driven through the mathematical model.
I understand, but you're giving to the same group too.